In 1955, a man named Richard walked into a brokerage office in Philadelphia and did something his father would have called reckless. He took $8,000 in savings, everything he had accumulated working as a draftsman for 6 years, and put it into a diversified basket of American stocks. His colleagues thought he was gambling. His wife made him promise not to look at the statements more than once a year. He held for 30 years, reinvesting every dividend, never touching the principal. When he finally sat down to calculate his wealth in 1985, the number on the page was $610,000. Then his accountant handed him the second number, the one that mattered more. After accounting for the taxes owed on 30 years of dividend income, the capital gains distributions his fund had been triggering without his knowledge, and the tax bill on the eventual sale, Richard's actual after-tax wealth was $390,000. He had done everything right. He had saved aggressively, invested patiently, held through multiple recessions, and never panicked. And a third of the number he thought represented his success quietly did not belong to him. He wasn't cheated. There was no fraud, no bad advice, just a mechanism built into the structure of how investing works in a taxable account that nobody had ever fully explained to him and that he had never thought to ask about because the number on the statement always looked fine. That mechanism has a name. It is called tax drag. And in 2026, with investment accounts larger and more widely held than at any point in history, tax drag is the single most underestimated destroyer of long-term wealth that I know of. Not market crashes, not bad stock picks, not even fees, though fees matter. Tax drag, the slow, invisible, completely legal, entirely preventable erosion of compounding that happens when your investment gains are taxed before they have the chance to compound into their full potential. This is not about motivation. It is about a structural reality in how investment returns are calculated versus how investment wealth is actually accumulated. By the end of this, you will understand exactly what tax drag is and why the reported return on your fund is not the return your actual wealth receives. You'll understand the mechanism that makes tax drag compound against you the same way interest compounds for you. You will see why two investors can hold the exact same fund, earn the identical market return, and end up with radically different amounts of real wealth based entirely on where and how they hold that fund. And you will have a practical framework for restructuring your approach in a way that lets compounding work at its full capacity rather than at a taxed fraction of it. Think of your investment account as a pipe carrying water uphill. The market return is the water pressure pushing the water up. Compounding is the pipe extending further and further uphill over time, carrying more volume with every year. That is the standard picture. Here is what tax drag does. It installs a valve in the pipe. Every time water passes through, the valve diverts a portion of the flow into a separate container that does not go uphill. It goes sideways. Gone. The water that gets diverted does not compound. It does not extend the pipe. It is permanently removed from the uphill journey. And the higher the valve's diversion rate, the shorter the pipe is every year than it should have been. That is tax drag. The valve is the tax. The diverted water is the portion of your gains that goes to the government before it has the chance to compound further. And the pipe that stops short of where it should have reached is the retirement account that is $200,000 or $400,000 smaller than the math suggested it would be. The mechanism works across three distinct channels, and most investors are only dimly aware of one of them. The first channel is dividend taxation. When a stock or fund pays a dividend, that payment is a taxable event in a standard brokerage account. Even if you immediately reinvest the dividend, even if the money never leaves your account, the IRS treats it as income received. Qualified dividends are taxed at 15% for most investors, 20% for high earners. Ordinary dividends are taxed at your full marginal income rate, which can be 32% or higher. Every time a dividend flows through your taxable account, the valve opens. A portion gets diverted. That portion will never compound. Here is the arithmetic on what that costs over time. Suppose you hold a fund with a 2% annual dividend yield on a $200,000 position. That is $4,000 in dividends per year. If you are in the 24% bracket, and these are ordinary dividends, you owe $960 in taxes. That $960 does not compound. Over 20 years, at a 7% return, $960 that compounds uninterrupted becomes approximately $3,720. You are not just losing $960, you are losing $3,720 in future value. And that is just 1 year's dividend on one position. Multiply across a full portfolio, across 30 years, and the pipe has been cut substantially short. The second channel is capital gains distribution. This is the one that genuinely surprises people when they first encounter it because it feels profoundly wrong. Actively managed mutual funds buy and sell holdings inside the fund throughout the year. When they sell a holding at a profit, profit. That profit is a realized capital gain. The fund is legally required to distribute that gain to its shareholders annually. It does not matter whether you personally sold anything. It does not matter whether you have held your shares for 1 month or 20 years. You receive a capital gains distribution, and it is a taxable event. In a high turnover, actively managed fund, these distributions can be substantial. In some years, a fund that has had a negative total return will still distribute capital gains because the manager sold winning positions to fund redemptions from exiting investors. You lose money. You owe taxes, both in the same year. Vanguard published research showing that in a given 10-year period, the average actively managed mutual fund in a taxable account loses approximately 1.8% per year to taxes, not to fees, to taxes. On a $300,000 portfolio growing at 7% gross, 1.8% of annual tax drag over 20 years does not cost you $108,000. It costs you closer to $280,000 in foregone compounding. The valve was open the entire time. The third channel is the most personal and also the least predictable. It is the tax consequence of your own trading behavior. Every time you sell a position in a taxable account, you potentially trigger a capital gain. Short-term gains on positions held less than a year are taxed as ordinary income. Long-term gains on positions held more than a year receive the preferential 15 to 20% rate. The problem is that most investors do not think of rebalancing, fund switching, or even modest portfolio adjustments as tax events. They are: sell your international fund to increase your U.S. allocation. You have triggered gains on everything you sold. Rotate out of a growth fund into a value fund during a market shift. Same thing. Every transaction where a gain exists is a valve event. The pipe shortens. Here is the historical proof that this is not a marginal consideration. In 1994, two finance researchers named Robert Jeffrey and Robert Arnott published a paper in the Journal of Portfolio Management titled, "Is Your Alpha Big Enough to Cover Its Taxes?" They compared the after-tax performance of actively managed funds to passive index strategies over a 10-year period and found that after accounting for tax drag, a majority of actively managed funds that had outperformed the index on a pre-tax basis actually underperformed it after taxes. They were simply generating it in a way that was so tax inefficient that the drag consumed the advantage and then some. The valve was taking more than the extra pressure was adding. 2 decades later, Morningstar did a comprehensive update of this analysis across a longer time horizon and came to the same conclusion. Tax drag doesn't just reduce returns. In many cases, it reverses the ranking of strategies entirely. And because statements always show you the pre-tax number, most investors never see the reversal. Here is the psychological trap, and this one is subtle in a way that makes it particularly dangerous for intelligent, attentive investors. Most people who pay attention to their investments do so by looking at their account balance and their reported return. Both of those numbers are pre-tax in a taxable account. The account balance does not subtract the deferred tax liability embedded in unrealized gains. The reported return does not subtract what the tax consequence of achieving it actually was. So the investor sees a number that feels accurate and complete. They compare it to market benchmarks, which are also pre-tax. They feel good when it matches or beats, and the slow diversion of the valve operates invisibly in the background, never appearing on the statement, never being reported in the headline figure. This is not a conspiracy. It is just how the numbers are presented. But the result is that investors systematically overestimate their actual after-tax wealth, and therefore systematically underestimate how much they need to accumulate to hit their real financial goals. Nina is 38. She earns $130,000 a year, invests $18,000 annually, and has a $220,000 taxable brokerage account holding a mix of actively managed mutual funds with an average annual turnover of around 80%. The funds collectively distribute about 1.5% per year in capital gains and pay a 1.8% dividend yield. Her effective tax rate on these events is around 26%. She earns a 7% gross annual return. Her actual after-tax annual return is approximately 5.2% after the valve takes its share. James is also 38. Same income, same $18,000 annual contribution, same 7% gross market return. But James holds low turnover index ETFs in his taxable account. The ETFs distribute almost no capital gains due to their structure. Their dividend yield is around 1.3%, mostly qualified, so the tax rate is 15%. James' after-tax annual return is approximately 6.7%. Over the same 25 years, James accumulates approximately $1.74 million. Same market, same contributions, same time horizon. The difference is $430,000 $30,000. Not from picking better stocks, not from clever timing, from understanding where the valve is and keeping it mostly closed. 5 structural decisions that eliminate or reduce tax drag without requiring you to predict markets or change your risk profile. First, use tax-advantaged accounts for your highest tax assets. Bonds, rights, and dividend-heavy funds generate ordinary income or frequent distributions. These belong in your 401k, IRA, or Roth account, where the tax valve does not exist. Low turnover equity index, ETFs, are the canonical example. The idea is tax location, not just asset allocation. Where you hold something matters as much as what you hold. Second, inside your taxable account, prefer ETFs over mutual funds for the same exposure. When investors sell shares of a mutual fund, the fund often needs to sell holdings to raise cash, triggering gains that get distributed to all remaining shareholders. When investors sell ETF shares, they sell on the open market. This is not a marginal difference. It is why 2 funds tracking the identical index, one structured as a mutual fund and one as an ETF, can have dramatically different tax consequences in the hands of a taxable investor. Third, hold your winning positions and do not trade. Every year you hold an appreciated position rather than selling it, you are deferring the tax on that gain. Deferred tax is not free money, but it is an interest-free loan from the government on the gain, and that deferred amount continues compounding in your account rather than being diverted to the IRS. The compounding on deferred gains is real and significant over long periods. The instinct to rebalance, to take profits, to rotate into something that looks better. All of these instincts are valve opening events. Fourth, use tax loss harvesting deliberately during down years. When a position in your taxable account is sitting at a loss, selling it and immediately replacing it with a similar but not identical fund locks in a tax deduction while keeping your market exposure essentially unchanged. The loss harvested can offset capital gains elsewhere in your portfolio, or up to $3,000 of ordinary income per year, with the remainder carried forward indefinitely. Done consistently, this is the one legal mechanism that turns market volatility into a tax benefit. It does not change your investment return. Fifth, if you are in a position to consider it, long-term the asset in the Roth account. A position that compounds at 7% for 30 years in a Roth account grows 7% a year. On a $100,000 starting position, 30 years at 7% produces $761,000. The Roth is not a better investment. It is the same investment with the valve removed, because the numbers are significant, but the life-level consequence is where this becomes real. Richard, the draftsman from 1955, spent 30 years building what he thought was his retirement. He did not panic, and when the moment of accounting arrived, he discovered that a third of what he had built had been quietly diverted along the way, not through negligence, but through a structural reality he had not been shown and had not thought to investigate. The tax system is not designed to punish investors, but it is not designed to maximize their compounding either. It is designed for a government with revenue needs, and the natural result of operating an investment portfolio inside that system without attention to its tax mechanics is exactly what happened to Richard. The people who end up with the most real after-tax wealth over a long investing career are not always the ones who earn the highest gross returns. They held rather than traded. They chose structures that kept the valve mostly closed, and they did the one calculation most investors never do. Not what did my portfolio return this year, but what did I actually keep? That calculation changes the game, not because it reveals a conspiracy, but because it reveals a mechanism. And once you understand a mechanism, you can work with it rather than against it. Here are your 3 takeaways. 1. Your pre-tax return is not your wealth. The number on your statement includes gains you have not yet paid taxes on. Your actual after-tax wealth is lower, sometimes significantly lower, and closing that gap requires knowing where your tax drag is coming from. 2. Tax location matters as much as asset allocation. Putting the right assets in the right accounts is one of the highest return decisions available to a long-term investor, and it requires no market prediction and no increased risk. 3. Every transaction in a taxable account has a tax consequence, not a reason to never transact, a reason to know the cost before you do. The investor who treats trading as free is paying a price that simply does not appear on the confirmation screen. The valve is in the pipe. It has always been in the pipe. The question is whether you know where it is.